Joining us now is Shana Sissel, Banrion Capital Management founder and CEO. So if you take what Javier was talking about, Shana, the risk of longer-term oil and price disruption, plus let's not remember we already had private credit concerns, we had an ugly jobs number, and yet we have stocks right back where they were in November. Are you surprised about the lack of bigger scale moves from risk assets today and last week?
Not necessarily. I've said this a million times before, and I feel a little like a broken record saying it again, but I think this is more a reflection of the vast majority of the generational investors in the pool that are driving sentiment. We've seen over the last almost 20 years since the great financial crisis, we've taken a lot of hits over time, and we've somehow managed to, blow right through them and quickly recover. I think this initial reaction is reflective of market sentiment and investors feeling like, oh, this is just one more thing. This is not investor base, largely speaking, that remembers, 1999, early 2000s, and those wars and everything that came before that in the 90s as well. And so I'm not sure that this is a sentiment that can continue or will continue, but I think that initial reactions is really a reflection of the investor base's historical framework.
Shana, we did see yesterday Brent crude coming up to over $119 a barrel. WTI is right there with it. That was that price very much calmed down when talk of a concerted release from the G7 strategic oil reserves circulated. We're now hearing from the French that the G7 is not there yet on releasing oil stockpiles, and as a result, we're seeing oil float back up. Right now, WTI at $104 a barrel, Brent crude at $105 a barrel. How does this price affect the stocks that you're invested in? Like, what do you want to do as an equity investor when you see these prices for oil?
Well, when you see these prices for oil, you want to have potential exposure to oil and energy names. And you're seeing in movements today that those are the stocks that are doing the best. But again, I think it's possibly short-lived. That said, the price of oil where it is today and how that impacts the price at the pump, I think, is what we should be focusing on. Because that's going to affect consumer sentiment, consumer spending, and that is the lifeblood of the U.S. economy and, quite frankly, the global economy. And I think that should be the bigger concern is it doesn't flow directly to the pump right away. So how long does it have to stay at these levels before it starts to impact the price at the pump and thus the U.S. consumer?
Well, but we're already seeing that impact. I mean, if you look at, for example, the AAA regular gas index, it's floated up from really the high 2s to 350 in the last couple of weeks.
Yes, but you're talking about a consumer that saw $4 a gallon not so long ago. And I know just my initial thoughts when we fell under $3 was, wow, I didn't realize oil was so cheap, and that made me happy. And then it floating back up to $3.50 just made me feel like more of the same. It has to move over $4 before I think the U.S. consumer starts to really notice it on their pocketbook.
What do you then do with sectors, Shana, that are highly exposed to travel and fuel prices? Airlines being one of them, cruise operators being another. Both sectors are down about 20%, so entering into a correction, because not only is it that high fuel prices, it's what you're talking about, the threat of a consumer that feels hamstrung and spends less elsewhere. For stocks like that that are really beat up, can you dip a toe in, or is it too uncertain? What do you do with the travel sector?
Well, first, I want to apologize for showing my Boston by saying the word pocketbook. And then second, I want to just mention that, yeah, I'm not touching anything that's highly sensitive to the price of oil right now. I'm not even dipping a toe in. There's too much volatility and uncertainty, and I'm dipping toes into things that are cheap based on fundamental factors that I have some visibility into, and I feel really good about. I don't think we have that with anything that's sensitive to oil prices. And so I'm not going to be dipping my toes into the travel sector right now.
So you're not, I mean, this is the first thing that was said, and I have a hedge fund dad's carpool. Last week was, hey, who's going to buy the cruise liners today? That was a week ago. And now we've seen them as the worst performers. You don't think they've been punished enough to go in there and buy some of that?
Well, first off, having a hedge fund dad like carpool and group chat sounds absolutely captivating. But I will say that, no, I don't think so. Again, before it was more like this war is going to be short. This is just a quick reflection of, unrest right now, but it'll blow over and we'll move on. But I think that the announcement today on the new Ayatollah and kind of the hard line that Iran seems to be making here suggests that this is not going to be something that we go and blow through quickly like we have in other geopolitical events as of late. And so I think that, again, I'm staying away from anything that's highly sensitive to the price of oil.
Shana, you did say there were some things that you're cautiously going back into. What would those be?
So I am looking at, the stuff that was really sexy a week ago. AI, things related to technology, things related to moving away from commodity-based energy related expenses. So I like Corning from a fiber optics standpoint. I might be looking at things that are alternatives to oil-sensitive names. So, if you want to, and again, I'm saying this as an example, not necessarily a recommendation, but I might be looking at anything having to do with electric power, anything having to do with alternative forms of energy. Those things I might be taking a second look at, because since the Trump administration took over, there has been this feeling that we're not going to be so hard on oil anymore, and we can be more involved in the areas that are sensitive and stay away from these things that hadn't really been working anyways. They were really being propped up by subsidies and government push towards away from oil-based energy. This is the reminder that it's not really necessarily about subsidies and a government push away, but a necessity to move and shift away from oil dependencies, particularly in the Middle East, which I think we've largely forgotten about over the last, say, 5 to 10 years, because we haven't had any real significant disturbance there other than what happened in Israel. But even that seemed very limited to that space and not necessarily impacting the oil-producing countries in that region. And so I think this is a good reminder that all this shift to focus on alternative energy really never had to do with a government push to subsidies and whatever. It really had to do with this type of potential volatility in the geopolitical world of the Middle East.
Right. And, I mean, the future of our children's world, right? Shana Sissel of Banrion Capital, thanks so much for joining us.